Hi, welcome back to another podcast with Mr. Hagan. And on this podcast, we're going to build the aggregate demand curve as part of the introduction to the aggregate demand, aggregate supply model. So let's get right at it. So this graph on the right-hand side, this graph over here, is going to be a graph of the aggregate demand curve. So when we graph the aggregate demand curve, first of all, we got to be really careful. It looks like, and if you're taking notes on this, don't write down what I'm about to write here for a moment. This looks like a normal demand curve, right? It's a downward sloping curve, and you might say, oh, the price of whatever some good is, maybe it's the price of a pair of jeans, and it's the quantity of a pair of jeans, and this is the downward sloping demand curve, and when the price of jeans goes down, people buy more jeans. I want to be really clear to say that's not what's happening here. That's not what an aggregate demand curve is all about. So let me get rid of that. Let me back up and get rid of all of this, and let's try this again from the start. So what this is really going to look like is this. This curve is not a demand curve. It is an aggregate demand curve. And the variable here on the horizontal axis is not the quantity of some one particular good. It is the total spending or total production or total income, because remember, GDP is all of those things. It is the real GDP on the horizontal axis. It's the total spending, it's the total production, it is the total income in all of society. That's what's on this horizontal axis. Is the real gross domestic product. And then on the vertical axis is the price index. So this might be measured by something like the CPI or something along those lines. And so we might be at some price index, we'll just call it P1, and at that price index of P1, the real gross domestic product might be Y1. And let's just put numbers on this for a second. Remember, maybe this is measured by the CPI, so the price index might be, 165, and that means prices are 65% above where they were in the base year. We talked about that on some previous videos. And then the real gross domestic product might be like maybe 15 trillion. Maybe we produced $15 trillion worth of goods and services, and we talked about that on previous videos as well. And so what we want to show here is that there's an inverse relationship between the price index and the real gross domestic product. We want to show that the aggregate demand curve slopes down, and there's going to be three reasons for the downward sloping aggregate demand curve. So let's go ahead and go through these. The first one, some places will call this the real balance effect. I'm going to call it the wealth effect. Is what I'm going to call it. And a lot of books do call it the wealth effect, and that's just my preferred. I think it captures the idea. And so let's say this. Let's say that we get an increase in inflation, and that the price index is rising. That prices in society as a whole are going up. If prices in a society go up, okay, let's imagine this. Let's pretend for a moment that you have $1 million portfolio. You have $1 million of stocks and bonds and bank accounts and whatever, and that you can use that $1 million to buy goods and services, to go out and live your life. And let's say that prices go up. In fact, let's say the prices double. Well, if prices double in society, then all of a sudden, all the things that you want to buy with your $1 million portfolio, a house, a car, food, going to the doctors, whatever it is, the normal stuff is that you buy, the price of all of that is doubled. And so your $1 million isn't really $1 million anymore. Your million, what your $1 million used to buy you, now it doesn't buy you that same amount of stuff. So in fact, if prices double, your $1 million is really now only worth $500,000. Like, your ability to buy goods and services has been cut in half. And so what we would say is that when prices go up, when you get inflation, your real wealth is going to go down. Your real wealth is going to go down. So yeah, you have the same $1 million, but everything costs twice as much to buy. And so you can really only buy half as much as you used to. So your real ability to buy goods and services is cut in half. Your real wealth declines. And then the rest of this is pretty straightforward. I think if your real wealth goes down, then that means you're going to reduce your consumption of goods and services because you just don't feel as wealthy as you did before. And as a result of that, that would be called a decrease in aggregate demand. Why? Because really, what is aggregate demand? Aggregate demand is really what? Aggregate demand is really just like aggregate expenditure curves. It is the total spending in society. So it is C plus I plus G plus NX, which, by the way, is also, so that's the aggregate demand. It's also the aggregate expenditures from the previous model. And if we might sneak it in here, it's also Y. It's also, I'm running out of space here, I'm sorry. It's also Y. It's also your GDP. So these things are kind of all the same thing. It's the total spending, it's the total production, et cetera, et cetera. So what we're saying here is if prices go up, if we get an increase in prices in the price index from P1 to P2, maybe the price index goes up to whatever. Maybe the price index goes up to 100. Goes up to like, let's get rid of that. Goes up to 250 or whatever. You get this big increase in the price index. That means that my real wealth is going to decline. That means I will engage in less consumption, and that means my aggregate demand, my total spending, my GDP is going to decline. And so we show that on this aggregate demand curve. That's why the aggregate demand curve is downward sloping. So then this would be Y2. My total spending or GDP would decline, and maybe it would decline to like 14 trillion or whatever the number happened to be. And so what happened here when all of this happened is we moved along the aggregate demand curve. We moved along the aggregate demand curve from this point, P1Y1, from P1Y1 to P2 Y2. And so we moved along the aggregate demand curve. And why did we move along the aggregate demand curve? We moved along the aggregate demand curve because there was a decrease in consumption. There was a decrease in consumption. All right, let's do the second one of these is the interest rate effect. The interest rate effect says this. The interest rate effect says that if you get an increase in prices, if you get inflation, then then I need more money to, I need to use more of my money to buy goods and services, and that means that my savings are going to decline. There's going to be a decrease in the amount of money that I can save because to buy my normal goods and services, I need to spend more because everything costs more. So to buy my food, to buy a car, to go to the doctors, to pay my cable bill, to pay my phone bill, all that stuff costs more, eats up more of my money. And so that means I can't save as much as I did before. If I can't save as much as I did before, then if there's not as much savings out there, then that's going to cause interest rates to begin to rise. Interest rates are going to begin to rise. So the supply of what we call loanable funds goes down. So people who want to borrow money, people go to the bank and they want to borrow money, and now because where do banks get the money that people want to borrow? Well, they get it from people saving. When you save money and you put it in the bank can then lend it out to other people. But now, because you're not saving as much, the bank doesn't have as much money to lend out to other people. So people show up at the bank, companies show up at the bank, and they want to borrow money, and there's less of it there because people are saving less. And so in order to try to get some of that money, to borrow some of that money, they're going to have to bid up interest rates. They're going to bid against each other, and interest rates are going to rise. So interest rates really are it's just like the price of borrowing money. And the supply of money in the form of savings went down, and therefore kind of the price of borrowing money went up. So savings goes down, interest rates go up. If interest rates go up, that means that companies are going to borrow less money. It's more expensive to borrow money. They're not going to borrow as much. And as a result, investment's going to decline. You're going to get a decrease in investment. And if investment goes down, well, here it is. That's part of the aggregate demand. If investment goes down, that means aggregate demand is going to go down. That means aggregate demand is going to go down. And again, that means that you're going to move along the curve. In this case, you're going to move along the curve because of a decrease in investment. And then finally, the last one of these is what is called the international trade effect. So the international trade effect is just says this: if the prices of goods and services in the United States goes up, then other countries are going to buy fewer of our goods because they're more expensive. So our exports are going to go down. That one's pretty obvious. And then on the other hand, if our prices go up, Americans are going to say, oh man, instead of buying, American goods whose prices went up, I'll just buy goods from France or Japan or from some other country. And so our imports will rise. So if prices go up in the United States, our exports go down, fewer people will buy goods from us, fewer foreigners, and we will buy more foreign goods because our goods cost more. Either way, both of those things will cause the net exports to decline. Both of those will cause net exports to decline. And if net exports decline, well, there it is. Net exports, part of aggregate demand. If net exports go down, then total spending goes down. That means aggregate demand goes down. And so again, here's that relationship. As prices go up, aggregate demand, GDP, goes down. In this case, it's because of net exports. And so all of these things are going to move us along the curve. Why? What are all of them saying? All of them are saying higher price, lower aggregate demand. Higher prices, lower aggregate demand. Higher prices, lower aggregate demand. Moving along the curve, when prices go up, you get a decrease in consumption, investment, and net exports, and that decreases the aggregate demand. And by the way, this would all be the opposite. If prices went down, this would all be the opposite, and aggregate demand would go up. So there's an inverse relationship between prices and gross domestic product. All right, this has been another podcast with Mr. Hagan. Thanks for joining me, and we'll see you on the next podcast.